era.
And, well, imagine waking up to headlines that human civilization is quite literally on the brink of collapse, only to watch the stock market spontaneously generate $1.5 trillion in new wealth by lunchtime.
Yeah, it's been an absolutely wild ride today.
Welcome to our deep dive. Today is Wednesday, April 8th, 2026. And look, if you are checking your portfolio right now, you might honestly be suffering from a serious case of systemic vertigo.
I mean, I certainly am.
Right. After weeks of just this suffocating geopolitical dread, the Dow surged over 1,300 points today. And crude oil just collapsed, dropping a staggering 15% in just a matter of hours.
It really is a remarkable testament to how quickly, risk can be priced into and then completely out of the global financial system.
And that is exactly our mission today.
Yeah.
We are going to unpack the mechanics of this impossible whiplash. We'll explore how a massive, last-minute geopolitical off-ramp triggered this historic wealth creation. We'll also look at why automated market algorithms might still be completely mispricing the reality on the ground, and what this extreme volatility means for the $690 billion AI infrastructure race we've been tracking so closely.
But before we dig into all those numbers and narratives, we really should quickly state our standard disclaimer.
Go for it.
Everything we discuss today is purely for market context and educational discussion. It is not personal investment advice or an investment recommendation.
Spot on. So what set the stage before the U.S. session?
Well, to really understand the explosion of buying we saw today, you have to feel the sheer panic that dominated the prior session on April 7th.
Oh, it was awful.
Yeah.
U.S. indices were just plunging. I mean, the President of the United States had just issued a literal whole civilization will die ultimatum to Iran over their blockade of the Strait of Hormuz.
Exactly. The tension wasn't just palpable, it was historically significant. We were staring at absolute maximum fear.
Because the Strait of Hormuz is the global energy choke point.
Right. And with it sealed, the market was being forced to price in the absolute worst-case scenario, which is a devastating energy-driven global recession.
But then, the script just flipped entirely. Late on April 7th, at 6:30 p.m. Eastern Time, which is well after the U.S. market close, and just an hour and a half ahead of an 8 p.m. military deadline.
The U.S. announced a 2-week military ceasefire agreement.
Yes. And the non-negotiable condition of that agreement was the immediate reopening of the Strait of Hormuz to international shipping.
And this gives us just a perfect opportunity to understand a foundational mechanism of the markets, which is the equity risk premium, or ERP.
Okay, break that down for us.
So think of the equity risk premium like a psychological insurance policy. For weeks, the blockade in the Middle East had artificially inflated that premium. When you, as an investor, face a massive systemic risk hanging over the market, you demand a much higher potential return to justify holding risky assets like equities instead of just, safe cash.
Basically, you demand to be heavily compensated for your anxiety.
Precisely. That anxiety raises the overall cost of equity capital across the entire market. But the moment the news broke that the Strait was reopening, that specific, catastrophic systemic risk just vanished.
The threat of oil rocketing to $200 a barrel just evaporated overnight.
Exactly. And because the risk premium compressed so rapidly, what you saw in the indices today was a mechanical, instantaneous upward re-rating of equity multiples.
And just to clarify that mechanism for a second, because it's important, when we say multiple expansion, we mean investors are suddenly willing to pay a higher price for the exact same dollar of a company's earnings, simply because the macro-level fear has been removed.
That's right. The discount rate applied to future earnings dropped, so the present value of those future cash flows automatically went up. It is the market functioning perfectly as an efficient discounting machine.
Okay, but here is where I have to push back on the textbook theory.
Oh, here we go.
I mean, treating this like a clean mechanical equation assumes the market rationally resolved a random, unpredictable shock. Geopolitics is not a random weather event.
No, it's not.
It is sequential human game theory. And the machines totally failed to read the room.
So you're saying the algorithms missed the diplomatic maneuvering?
Completely. Think about the algorithms that were blindly dumping stocks on Tuesday morning when that scary "civilization will die" headline hit the wire. Earlier that same day, the Prime Minister of Pakistan publicly pleaded for a 2-week extension to the deadline.
Right, I remember that.
To any seasoned geopolitical analyst, that was a clear, calculated poker move. It signaled that back-channel negotiations were happening. But the text-scraping algorithms, they don't understand the nuance of a diplomatic bluff.
No, they don't.
They just scan for terrifying keywords, calculate a generic tail risk variable, and execute massive sell orders. They completely mispriced the diplomatic off-ramp that human traders could clearly see forming.
I will concede that the academic models struggle immensely with human nuance. I mean, an algorithm cannot read the subtle diplomatic back-channeling between global leaders. It really merely reacts to the statistical probability of an oil supply shock based on historical data. So you are entirely correct that bounded rationality comes into play here. The automated systems fail to accurately probability weight the likelihood of a last-minute resolution.
Yeah. And once that resolution actually materialized, the relief wasn't just confined to Wall Street. It swept across the entire global timeline overnight.
We saw it clearly in Europe early this morning on April 8th. This massive geopolitical relief dovetailed perfectly with some key regional data.
What data was that?
Well, at 5 a.m. Eastern Time, Eurostat released their Eurozone Industrial Producer Price Index data. It indicated that industrial inflation pressures were somewhat stabilizing. That data point helped keep European central bank yields anchored.
So you have steady bond yields colliding with a massive drop in forward oil prices.
Which is absolute rocket fuel for European equities. The DAX in Germany and the CAC 40 in France surged nearly 5% in response. The overarching relief simply dominated the tape.
It was so dominant that it completely drowned out other major central bank news. Like the Reserve Bank of New Zealand issued a rate decision at 10 p.m. Eastern Time last night, and the Reserve Bank of India did the exact same at 12:30 a.m. Eastern Time.
Right.
Ordinarily, those decisions give us vital reads on Asia-Pacific monetary posturing, especially regarding how they are handling energy costs.
Yep.
But today, total radio silence from the market. They were entirely ignored.
The evaporation of the global risk premium was simply the only story that mattered globally, setting a spectacular stage for the U.S. trading hours.
Which is a perfect segue. So let's take a short break, and when we come back, we'll dive right into the opening bell.
Sounds good.
All right, we're back.
So what moved markets during U.S. trading hours?
Well, it was an absolutely chaotic U.S. session. Let me just anchor us with the hard numbers because they are staggering to hear out loud. U.S. equities gapped up hard right out of the gate and never really looked back.
Yeah, they really did.
The Dow closed up 2.85%. The S&P 500 added 2.51%, closing at 6,782, and the Nasdaq advanced 2.80%.
These are massive moves.
And the VIX, the market's fear gauge, it didn't just decline, it crashed 18.5% down to 21.00.
And we really should remember, the VIX isn't just a hypothetical sentiment score. It represents the actual cost of options contracts that investors buy to protect their portfolios against sudden drops.
Right, the insurance.
Exactly. When the VIX crashes 18%, it means the perceived need for that expensive insurance has plummeted.
Meanwhile, the underlying commodities and bonds saw a historic downside volatility. WTI and Brent crude literally plunged 15%, dropping below $95 per barrel. Concurrently, the 10-year Treasury yield, which has been stubbornly high lately, slid down to 4.26%.
And those falling inputs, the lower yields and cheaper oil, those are what provide the oxygen for that multiple expansion we were just discussing.
Okay, all right, let's unpack this valuation argument a bit further because my practitioner alarm bells are still ringing loudly here.
Fair enough.
We are talking about multiple expansion and discounting future cash flows. But did the intrinsic fundamental value of the 500 largest U.S. companies actually increase by $1.5 trillion between breakfast and lunch?
Well, in the strictest mathematical sense, yes. The cost of capital decreased, so the present value of their projected future earnings is technically higher today than it was yesterday.
But real-world business fundamentals simply do not move that fast. Apple didn't sell 1 billion more iPhones this morning.
No, of course not.
Microsoft didn't suddenly invent a brand new software paradigm between 9:30 and noon. I'd argue that this violent whiplash is an illusion of precision.
How so?
This wasn't a bunch of rational analysts calmly recalculating cash flows. This is driven by mechanics.
Yeah.
Massive short covering. Imagine you bet millions against the market and suddenly the apocalyptic news is gone.
You have to buy.
You are forced to buy stocks to cover your short positions immediately, creating a liquidity vacuum that drives prices up vertically. Today, the market wasn't a perfectly efficient calculating machine. It was an emotional mob scrambling for the exits.
That is a very fair critique. True price discovery is a process. It takes time. The intrinsic underlying operating reality of these businesses did not fundamentally alter overnight.
Exactly.
The market absolutely acts as an emotional mob in the short term, violently overcorrecting from extreme pessimism to extreme euphoria. The mechanical models assume perfect liquidity and instant rationality, which, as the short covering squeeze demonstrated today, is rarely the reality on the actual trading floor.
And the proof that this was an emotional, fragile rally showed up right in the middle of the day.
Yep.
The euphoria actually cracked.
It did. At 11 a.m. Eastern Time, news broke that Israel had launched massive airstrikes against Hezbollah targets in southern Lebanon.
That was an incredibly destabilizing development, largely because Israel claimed that Lebanon was not explicitly covered by the U.S.-Iran ceasefire agreement.
Yeah, they found a loophole.
Yeah.
And the immediate consequence of exploiting that loophole was Iran threatening to reclose the Strait of Hormuz all over again.
And that headline injected severe midday volatility into the session. Crude oil actually bounced off its $95 floor.
We should also note that bounce was assisted slightly by the EIA U.S. crude inventory data that came out just prior at 10:30 a.m. Eastern Time, which gave traders some baseline supply and demand context.
Right, but it was really the geopolitical loophole that made equities pull back slightly from their session highs. It served as a stark reminder to everyone that this diplomatic peace deal is resting on a knife's edge.
A knife's edge is right. And as if the geopolitical drama wasn't complex enough, the Federal Reserve dropped a massive hawkish overhang right into the afternoon session.
Oh man, yeah. At 2 p.m. Eastern Time, the Federal Reserve published the minutes from its March FOMC meeting. The tone embedded in those minutes was highly concerning from a macro perspective.
Very much so. It revealed that policymakers are deeply worried the ongoing Middle East conflict will pass higher energy and transportation costs directly into core consumer inflation.
And this is the worst kind of inflation for a central bank. It's cost-push inflation, not demand pull. If inflation is sticky because global shipping is broken, the Fed is trapped.
Right.
They can't stimulate the economy by cutting rates, but keeping rates high hurts businesses.
Precisely. It materially lowers the odds of any interest rate cuts in 2026.
Which highlights another major flaw in the efficient market theory, in my opinion. The illusion of instant information diffusion. According to textbook finance, the moment those Fed minutes hit the wire at 2 p.m., the market should have instantly digested the reality of higher for longer rates and sold off equity multiples accordingly.
And you were observing that it didn't do that.
It completely ignored it. The market was so intoxicated by the ceasefire relief rally that it practically shrugged off a fundamental structural shift in monetary policy expectations.
That's true.
Human beings and human-run institutions have limits on how much they can process at once. It takes time to digest complex, multi-layered macroeconomic news. I would wager heavily that it will take a day or two for this sticky inflation narrative to actually price into these equities.
Yeah.
The initial euphoric reaction today was incomplete because the market just couldn't process the bad news while it was busy celebrating the good news.
Well, we did see a minor upward repricing in Treasury yields immediately after the minutes were released, which shows the bond market was paying attention. But you make a compelling point that the equity markets largely dismissed it to maintain their momentum.
Yeah.
It was a fascinating intraday tug-of-war between the sheer joy of the geopolitical ceasefire and the lingering heavy macro risks posed by a hawkish Fed.
A tug-of-war the bulls undeniably won today. So let's take one more quick break and then we'll dive into the corporate names that capitalized on all this chaos.
Perfect.
Okay, we are back. So corporate events recap and what to watch next.
Well, underneath all of this macro crossfire, there were some massive micro stories playing out at the corporate level, the most consequential one being Meta platforms.
Oh, absolutely.
At 9:30 a.m. Eastern Time, Meta unveiled a brand new, natively multimodal artificial intelligence model called Muse Spark.
And just to clarify natively multimodal for everyone, it means the AI isn't just translating text to an image generator in the background. It inherently understands text, audio, image, and video simultaneously from the ground up.
Which is incredible.
Yeah, and Meta is claiming this matches the frontier models from heavyweights like OpenAI and Anthropic.
Which is deeply significant when you connect it to the broader economic narrative. For weeks, we have been analyzing the $690 billion AI capital expenditure supercycle. Investors have been increasingly anxious, wondering if these massive physical infrastructure sprints, the data centers, the power grids, the cooling systems.
If you're actually going to yield monetizable competitive technology.
Exactly. Meta launching a highly competitive in-house AI model provides tangible proof that their massive CapEx spend is actually bearing fruit.
It turns theoretical spending into an actual product. and the market rewarded them handsomely for it. Meta shares rallied 6.5% today, essentially acting as the primary engine pulling the Nasdaq higher. But the software side wasn't the only winner. The hardware side caught a massive tailwind, too.
They certainly did. At 8 a.m. Eastern Time, Wall Street firm TD Cowen upgraded their price target on ASML, the Dutch semiconductor equipment manufacturer.
And if you aren't familiar with ASML, they are the absolute linchpin of the entire global AI revolution. They have a virtual monopoly on extreme ultraviolet lithography machines. Without getting too deep into the weeds, these are the only machines in the world capable of printing the microscopic circuits required for advanced AI chips.
So an upgrade on ASML isn't just about one company. It reinforces the momentum of the entire semiconductor and AI infrastructure supply chain. ASML shares surged 8.74% on the back of that analyst note.
Tech definitely flexed its muscles today. But honestly, the single most fascinating corporate story of the day belonged to Delta Airlines. They reported their first quarter earnings at 6:55 a.m. Eastern Time, well before the opening bell.
And the fundamental numbers were exceptional. They reported a record first quarter revenue of $14.2 billion, alongside an adjusted earnings per share of 64 cents, which comfortably beat the Wall Street estimates of 61 cents.
But what makes this so fascinating is why this matters today, of all days. Delta sits at the absolute intersection of the session's two biggest forces. On one side, their massive revenue numbers prove that consumer travel demand remains wildly resilient. People are still buying tickets, regardless of broader inflation fears.
Right.
On the other side, you have a 15% instantaneous drop in the price of crude oil because of the ceasefire.
Which means their primary variable operating cost, which is jet fuel, just got significantly cheaper in a matter of hours.
It is the ultimate scissors effect for profit margins. You have top-line pricing power staying strong, while the bottom-line costs are suddenly cut out from underneath them, widening their profit margin instantaneously. Delta stock jumped 8.2% today. And the sheer force of that logic dragged United Airlines and Carnival Cruise Line up right alongside it.
It's a textbook example of macro events instantly rewriting micro-level corporate valuations.
And honestly, it also gives us a painfully clear view of how absurd the automated trading landscape can be. Think about it. 24 hours ago, trading algorithms were aggressively shorting the entire market because they couldn't read the bluff in a Pakistani diplomat's speech, convinced we were headed for a global war.
Yeah.
Today, those same algorithms are desperately buying airline stocks at premium prices because the computers realized planes use less expensive gas when there isn't a blockade. It really makes you wonder if the smartest money in the room is just the one that doesn't panic at the first scary headline.
I mean, the algorithms lack the capacity for patience, which is exactly why understanding the broader context is so vital.
I gotta say, though, Delta Airlines wasn't the only thing taking flight today, as the Dow soared 1,300 points on the wings of a massive ceasefire relief rally. And, with crude oil plummeting 15% and the VIX crashing right alongside it, the only thing getting squeezed tighter than energy bears are our celebratory drinks. Enjoy the historic gains, because thanks to Meta's new AI and cheap jet fuel, both our tech portfolios and our upcoming vacation plans are fully funded.
I love that. But looking ahead to the next 24 hours, the landscape remains incredibly dense with potential catalysts.
Right. So what should we be keeping our eyes on tomorrow?
First, at 8:30 a.m. Eastern Time tomorrow, we have the U.S. initial jobless claims data. Given the Federal Reserve's intense focus on the resilience of the labor market, any unexpected weakness or strength there will be heavily scrutinized by the trading desks.
And obviously, we have to monitor the extreme physical fragility of this U.S.-Iran ceasefire.
Without a doubt, we need to watch the commercial tanker traffic in the Strait of Hormuz very closely. Does the physical flow of oil actually resume at a normal scale, or are shipping companies still too afraid of insurance premiums to send their vessels through?
Good point.
Furthermore, we have to monitor the escalation risks between Israel and Hezbollah. As we saw briefly this morning, any cross-border strikes there threaten to unravel the entire diplomatic agreement and send oil prices spiking right back up.
And what about the monetary side? Because my mind is still stuck on the market's delayed reaction to those Fed minutes.
That really is the pivotal question for equities. We will be watching closely to see how the market absorbs those hawkish FOMC minutes on a one-day delay. Will the reality of sticky core inflation finally begin to weigh on equity multiples tomorrow when the euphoric dust settles?
Yep.
We also have a slate of upcoming speeches from Federal Reserve officials. It will be critical to parse the rhetoric regarding today's sudden collapse in oil prices. Does a $95 barrel of crude actually ease their long-term inflation fears, Or are they still primarily focused on the structural deficits and the massive energy demands of the AI power grid?
It is setting up to be a fascinating battle between top-down macroeconomic risks and bottom-up corporate earnings power.
Which brings up a final structural question for you to consider as we wrap up.
Wow.
Let's assume this geopolitical risk premium actually stays compressed and the strait remains fully open. But at the same time, the Federal Reserve outright refuses to cut interest rates because this massive AI infrastructure sprint is straining the power grids and keeping core inflation sticky.
Okay.
Are we entering an entirely new financial era? An era where equities can only climb higher through sheer brute force corporate earnings and massive capital expenditure, rather than relying on the friendly, accommodative central bank policies we've grown so used to over the last decade?
We'd love to hear your take on whether this relief rally is genuinely built to last, so drop your thoughts in the comments below.